Good evening, welcome. We're going to allow 1 minute here for any other attendees to get in the room. So just bear with me for 1 second for any other attendees getting in here, as it took a second for us all to get in. Again, we're just waiting 1 minute for additional attendees, as it took a second for us all to get in here. Okay, welcome, ladies and gentlemen. Thank you for attending our seminar on elections, stock picking, and market timing. My name is Nate Burston, Portfolio Manager and Head of Trading with Biltmore Capital Advisors. We are an SEC-registered investment advisor with offices in Princeton, New Jersey, and Boca Raton, Florida, providing financial planning and wealth management solutions. Biltmore Capital's suite of services includes comprehensive investment strategies, including tactical asset allocation, retirement planning, income and asset protection, and here at Biltmore, we make sure to have the appropriate family conversations to ensure all members of the family are safe and secure. Should you have any questions, you can schedule a complimentary review with one of our senior advisors by clicking on the Offers tab on the right of your screen and find a link to their calendar. It is my pleasure to introduce Dr. Donald Chambers, who will be speaking to us tonight about elections, stock picking, and market timing. Dr. Chambers has a PhD in finance and has published 6 books, written over 50 articles, and done countless webinars to help educate people on finance. Biltmore Capital has been lucky to have him on the team for over 5 years now. You can find some of his previous informational seminars on our website, biltmorecap.com. That's BILTMORECAP.com. Again, if at any point you'd like to schedule a complimentary review with one of our senior advisors, please click on the Offers tab located to the right of your screen. At this point, I'll turn it over to Dr. Chambers.
Thank you, Nate, and welcome to everybody. I'm looking forward to this opportunity to talk about one of my favorite topics of my whole life, which is investments and how to handle your future wealth planning needs. So let's begin with this slide here, because we want to begin the discussion today about the forthcoming elections and what we ought to do about it and maybe what we ought not to do about it. The graph that's being shown here is a picture of what happened in overnight futures trading. This isn't the day-long New York Stock Exchange trading. This is nighttime trading in futures contracts. And what it indicates, it might be hard for some of you on some computer screens to read all of these small things that are on the graph, but at the very upper left-hand corner of the graph, it's at 8 o'clock, and it's just the polls are finally starting to close, and as they close, the futures contracts indicate a tremendous drop in the stock market, a drop of almost 1,000 points, which back then was over 5%. That's a huge drop, and it continued to drop all the way until midnight. Well past when I think most people figured the election was over. And then miraculously, it started to recover. It didn't recover all the way, but it recovered quite a bit of the way. So as we think about elections, what this diagram tells me a couple things. One thing is that experts were wrong. They were shocked at the election outcome. I was shocked. I'm not an election expert, but I was shocked at the outcome too. I did not think that Trump had a chance of winning, and I was very surprised. The other thing that is revealed in this graph is that people didn't know how to react to that. So the first 2 hours or 4 hours of reaction was very bearish, and then the next 4 hours of reaction was very bullish. And I could understand it being one way or the other way, but I can't understand why it would go down for 4 hours, then up for 4 hours. It doesn't make much sense. And I think that this is an important thing for us to think about when we think about an election. And that is that unexpected things can happen, and it's unexpected when they happen. And we don't even know sometimes how the market will react to these things. And this isn't the only example of an election or a political event that caused reactions that people really couldn't understand. So we'll see lots of studies even as we get closer to the election, of people that will come up with some statistic that if you invested 1 week before an election and held it until 2 weeks after, and you did only Democrats if they were not the incumbents, or Republicans if they were the incumbents, or whatever, and how well that strategy would have worked. Because, of course, we literally have thousands of people out there, each of which are trying dozens of different strategies to see how they worked in the last 50 to 100 years. And my belief, by the way, is that what happened 50 years ago and 100 years ago, maybe even only 20 years ago, is not relevant to the world that we live in today. In this sort of context, this is a whole new ball game that we're living in a variety of ways. So, what can we do about the election? And one thing I'd say we can do about the election is think about its implication for our tax planning. But we don't have to think about that until the results of the election are in. So I would urge you to take the election seriously in a tax consequence sort of situation, but not to try to game this by figuring out A, who's going to win the election, and B, what the effects of that would be on the market. In fact, if we look at this next diagram, it's the same diagram on the top, but I show this arrow going up to the right because whatever I may have thought on election night, I certainly didn't expect that it would be the preamble to about a 3-year bull market that was just incredible. So we can't predict these things, but that doesn't mean there aren't things we can do to prepare for them. I put these things about panicking at first and then followed by relief because I wanted to emphasize that I think a lot of the short-term reactions are emotional. And in my judgment, they're not very predictable. And I think that historical studies that try to imply that they are predictable can take you down a pretty bad path. An important thing to do to prepare for this election is to make sure that you know what you're doing in terms of your financial situation and the risks that you're taking, and that you have a financial plan. I'm going to come back to that later. But what I want to get across right now is so you can be emotionally prepared for whatever happens. Now, my concern about the election from an economic perspective, market perspective, is not so much about who wins. It's about, could there be, for instance, a constitutional crisis where there's tremendous political infighting about who actually is entitled to be president. And I think that could be catastrophic to the market. You never know. I could be wrong, but I think that would be pretty catastrophic to the market. So we want to be emotionally prepared for that. And it might not be the election that causes the next big crisis. It could be something real, like some sort of a huge terrorist attack, maybe nuclear, something like that. I don't want to scare people. Nothing to do with the election. Or it could simply be a panic. I remember the first panic that I lived through as an investment professional was in October 1987, when the stock market, for no apparent reason, dropped 30-some% in a period of 4 days, and 22% of that was on the fourth day. And the amazing thing about that is, to this day, I have no idea why it dropped so much. Imagine the stock market dropping 33%, and nobody can really explain why it happened. It was just kind of a panic. And that's why I have this up here about somebody with a panic face and somebody else just relaxed and not worrying. The next crisis that I remember vividly living through, as I'm sure most of you do, was the financial crisis, the global financial crisis, and in particular, October of 2008. And that was pretty scary, because it wasn't just that the stocks were going down, it was that the financial sector itself was in jeopardy. So how does one handle that emotionally? And I've got to admit that really got to me in October of 2008. Of course, we've all lived through this COVID stock market crisis that occurred in March and April, and we're going to talk about that in just a moment. But to be honest with you, from a financial perspective, I was very relaxed through that on behalf of myself and my own funds, as well as our clients' funds. So how does one get to that point of being prepared for an event? Whenever it's going to happen, are we emotionally prepared for that event? Because we don't want to go through these in an emotional way. that's probably the biggest point that I'm going to try to get across today, is how not to be emotionally reactive to whatever the next crisis is, whether it's this election or something else. Let's move on to the two topics at hand today. One is, to what extent should we be trying to pick stocks, stock picking, or it could be just a sector within the market. And then the second topic is, what about timing the market? And can either of those strategies be used, and what do I think about them? Well, first of all, what do we mean by stock picking? And I show this spectrum here. On the left side of the top axis here, it talks about at the very most furthest to the left is the most serious level of stock picking, which is where you would put all of your money in on just a few stocks. And then in the middle is where you'd say, well, I'm not going to pick stocks, even though we might call it stock picking. I'm really going to pick sectors. I'm going to get out of the tech sector. It's gone too high, or I'm going to get into some other sector. And on the right is the least stock picking. And this is what most of our wealth management is about at Biltmore Capital, and certainly in my life. And that's market-weighted diversification. You invest in each stock, each sector, each industry very closely to its market weight, how large it is. If it's a big sector, you invest more money. If it's a small sector, you invest less money. So when I talk about stock picking, I'm really talking about a spectrum here, anything from really risky stock picking, just all in on a few stocks, to not stock picking at all when you use market weights for your portfolios. Similarly, there's a spectrum when it comes to market timing. All the way to the left here, you could have somebody who times their whole portfolio in and out of the market. It's very possible to do that nowadays with the passive index funds and having money inside of mutual funds. So you could be all in or all out of the market, or you could use less severe forms of market timing, where you simply move from one sector to another, to a very small element of market timing where you would do tilts. This is something that we do at Biltmore Capital, is small tilt at an occasional basis. And then no market timing at all would be when you buy and you hold your portfolio and you only make changes to reflect occasional need to rebalance. So we're going to talk about, when I talk about stock picking and market timing, it could refer to a variety of more severe and less severe forms of those two. Before we get to that, I wanted to mention how important diversification is. And we're going to come back to this article that I'm going to talk about. When we talk about being diversified here, we're talking about not just holding 20 stocks or 30 stocks. We're going to get to this article in a few minutes. It's actually holding hundreds or thousands of stocks. And at Biltmore Capital, we do so many things to try to protect our clients. The money is kept with huge custodians that have extra insurance, and we do everything to safeguard against those sorts of problems, as well as being extraordinarily well diversified. And if at any point some of the things I'm saying aren't clear to you, I'm accessible. There's this offers button that you see over to the right of your slide. You should be seeing that. And you can click on there and you get a complimentary opportunity to talk to us about what it is we do and how we try to plan for volatility that is inevitably going to occur in the market. We just don't know when, and we don't know how severe it's going to be. But we're certainly going to be well diversified in our wealth management area. Now, this next picture diagram, I'm going to spend a little bit of time on. It might be hard for some of you to see it. It's kind of small on the screen, but I'll go through and I'll explain it. This is a graph from 1925 all the way to the left, all the way to date on the right. And it's showing you the amount that the assets have mostly gone up, but sometimes down in that last almost 100 years. And if you look at the lowest line, it's a blue line that ends in last place over there on the right-hand side. It goes up the least, and that is the inflation amount. So what it's saying is, and it's really hard to read these axes, but the picture, once I explain it, should be clear to you. And that is that if you had $1 in 1925, that would be equivalent in terms of purchasing power to having around $12 or $15 today. So what it's saying is that just to keep up with inflation, whatever you invested in 1925 would have to grow up to above that blue line in order for you to beat inflation on a pre-tax basis. And that line right above it, the yellow line, the second line up from the bottom, that's the money market or treasury bill line. And what that's saying is if you put your money in bank accounts and CDs and short-term treasury securities, that's where you'd end up. And you can see it's a little bit ahead of the inflation, but that's on a pre-tax basis. On an after-tax basis, it isn't going to be ahead of that. If you go up to the next two lines, it's kind of an orangish line and then a bluish line above it. The third line up from the bottom is government bonds. That's where investors that would have followed this strategy invested not in short-term federally insured bank deposits, but in longer-term government securities. And you can see that actually, even after taxes, is going to make a nice growth for you. Not fantastic, but you're going to grow your money there. The fourth line up, right next to that government line, is corporate debt. If you go a little bit further and you not only take interest rate risk, but now you're getting into corporates, so you're also taking credit risk, in the long run, you got a higher return. And the three lines on the top are all stock markets, and it differentiates between small and large caps, but the middle line is the important one. That's the all market line. Look how much that went up. Now, one thing about this diagram is its technical word for it is it's a logarithmic chart. And what that means is that it's trying to show profits in the late years in proportion to in the early years. If you do this by just dollar amounts, you get this just tremendously upward sloping line, and it really doesn't seem to mean much. So when we adjust it for logarithms, as we do here, it gives us a real picture of what was going up and how much volatility was occurring, how much variation was occurring. The important takeaway from this is that if you invested in the stock market, any of those top three lines, you would have gained 100-fold wealth or 1,000-fold wealth, even depending on which line, relative to if you kept your money simply keeping up with inflation. It doesn't look it on this graph, but this is a massive change in wealth. If you're in those top three lines, you made tremendous growth in the past almost 100 years. And any subpart of that, the stock market in the United States in the last 100 years has just done unbelievably well. It's done so well that academics have a word for it. It's called the equity risk premium puzzle. We're puzzled that equities so outperform other assets. We ask ourselves the question, why would anybody invest in anything else? And the answer is, or we really mean, why do they invest so little in stocks when they do so much better than these other assets in the long run? And the answer, of course, is risk aversion. If we put all of our money in the stock market and we get another Great Depression, we could literally lose our homes and all of our retirement savings. So this diagram is emblematic of how wealth allocators should think. This is how we should think about our money. And here's how I think about our money, and I urge you to think about the money. There's no doubt that the stock market is the place that in the long run is almost certainly going to perform the best. But it has the most risk. You can see how much those lines wiggle. So risk is our enemy. We don't like risk. We would rather have a guaranteed, very nice retirement than a 50-50 chance at a super retirement and an impoverished retirement. This is a risk aversion property that's normal and healthy. So what this means is that people, to the extent that they can tolerate the risk, should be in stocks. But most of us are not in a situation where we should be putting all of our money in stocks. So I want you to think of this diagram. And by the way, we use this diagram every quarter when our investment committee meets to reflect on this very topic. This is a battle of how much risk does it make sense to take. With higher risk comes higher average return, but with higher risk comes uncertainty in terms of whether you're going to be able to live the sort of lifestyle that you would expect to and want to live. So I view asset allocation as a battle of how much risk are you willing to tolerate in the expectation or hope of higher returns? It's a battle. It's a constant battle. And this is really relevant to what I'm going to talk about today about the election timing. And that is that risk is our enemy. We bear it grudgingly in order to get higher return. So the last thing in the world we want to do is bear a risk that doesn't reward us. So that's the takeaway point from this. And in addition to the general asset allocation here, when you look at this diagram, you can see it. Oh, a person with a long-term time perspective that is in a strong financial situation, maybe they've paid off their debts and they're have a nice retirement plan and Social Security. They could put a lot of money in equities, perhaps. And other people that perhaps are not quite as well off financially or are closer to retirement, maybe they're going to have to put more of their money in the bond sector. So that's the asset allocation decision. It's the most important decision that we make as wealth managers. And it's this battle between risk and return. And it teaches us that if we're going to take risks, we want to be rewarded for those risks. So let's move on. And I wanted to talk about one other thing before we went that. Sorry about that. And that is, when you see this general upward trend in stocks, this idea of timing in and out of stocks begins to lose some of its allure, because when something is doing this well for this long, it's really not the sort of thing that you want to time in and out of. You want to be in as much equity as you can reasonably tolerate and keep it there. And I'm going to explain why to keep it there in a few minutes. So what about short-term market timing? What if instead of timing out of the market for a year, which I'm saying is not a smart thing to do, because in the long run, stocks win. And the longer you time out of a market, the more risk you run of it running away from you. Well, what about short-term market timing? This is actually beginning in late February through April, the trading days of what happened to this stock market. And if you can read these numbers, if you can't read them, I'll tell you that the first 7 numbers are the first 7 days of the COVID crash. The stock market declined due to COVID. And when you look at those numbers, 7 days in a row down, and you say, wow, why don't we market time? Why don't, when we see a couple negatives, we get out of the market? Well, it's interesting. Yes, those first 7 days were negative, but when you go all the way through the rest of that crisis, it's hard to find 2 negative days in a row that then occur after that. So what I'm getting at is, if you see a trend like that and you get to the 4th or 5th day of it going down, you might say to yourself, oh my goodness, I should time out of the market. Well, that's when the market actually started to show a lot of resilience. And of course, now it's well back up. So we really want to be careful market timing. And I'll get some special points on that in just a moment. So in fact, we're here. It's maybe very hard for you to see this sheet here, but I'm going to explain it to you anyways. It's a spreadsheet that I created, and it uses random numbers. So even if you can't see it really closely, here's what I want you to understand that it shows. In the top 7 rows here, the big long row that extends all the way across, the top 7 rows, it simulates what happens if you invested in 20 stocks. This is a portfolio really talking about should you have 20 stocks in a portfolio, which is the top third? Should you have 10 stocks in a portfolio? And should you have 5 stocks in a portfolio? Of course, the real answer is you should have hundreds or thousands of stocks in a portfolio. But this is an exercise to illustrate the point. And it shows over in that right colored column the returns that you got in 7 simulations. This is all simulation that I did. The returns that you got in 7 different trials, 7 different runs. And it shows that the lowest outcome that you got if you invested in 20 stocks was a 1.3% return, and the highest that you got was an 8.8. So it's a moderate amount of risk. Then in the middle, it shows that this is just one random screenshot, but others are like them. What would happen if you only invested in 10 stocks? And we see that the outcome is a lot more dispersed. It goes from negative 0.2 up to 12.4. It's higher on both sides. If you only own a few stocks, there's a higher chance of getting a higher return and a higher chance of getting a very low return. That's the added risk. And then it shows if you only own 5 stocks, what happens. So this is kind of a way to visual first. And the answer is you could lose 5% in this simulation or make almost 15%. So this shows that the fewer stocks that you invest in, the more you stock pick, the more risk you take. But on average, it doesn't give you a higher return. And that's the key point that I want you to understand. And that is that when you concentrate your holdings into a few stocks, you're taking more risk. But you need to take more to get a lot higher return to compensate you for that risk. And it's a rare situation where taking that higher risk is worth, even if you could on average make a little more money with your stock picking, it still isn't offsetting the higher risk that you're taking. And here's another point, and this may be difficult to visualize, but maybe you can reflect on it, and I'd certainly be happy to talk to people about it. But it looks like exactly the same spreadsheet. It's not. This is about market timing. Now, notice in the first slide, the top third of the diagram was what happened if you invested in 20 stocks. Now what I'm trying to show is what would happen if you invested not in 20 stocks, but you invested in the market for 20 time periods. And in the middle panel, you only invested for 10 of those time periods, not necessarily the first 10 or the last 10, just 10 that you picked because you're market timing in and out. And then the last panel shows what happens if you timed into the market for 5 of the time periods and you timed out for 15. And you get the same result over on the right-hand side. And that is that when you time in and out, actually these summary numbers don't indicate this is fully, because it's just a random trial. But if you kept repeating this trial, the pattern that you would see is that if you invested for all 20 days, you would get 20 time periods, you get a smaller variation than if you concentrate all of your investing and risk taking into only 10 time periods or only 5 time periods. What we're getting at here is that the more you market time, the more risk you're taking relative to the reward. It's really just like stock picking. Concentrating all of your money in only 10 or 5 stocks is as bad as concentrating all of your investment risk into only 10 days or 5 days or 10 months or 5 months. We want to spread our money among stocks, and we also want to spread it out across time. This is kind of a point that some of you might, relatively new to this, or my explanation might not be great, might not be fully grasping. But what this portfolio analysis teaches us is diversify across stocks and diversify across time. That those words are sometimes used incorrectly. But when I'm talking about diversifying across time, I'm saying keep your risk steady through time. Don't jump in and out of the market, because jumping in and out of the market will create volatility. You're better off keeping a smaller amount of your money in the market all of the time than to be tremendously overinvested in the market sometimes and underinvested other times. And if you really think about that, the two concepts are really identical. So if you understand why diversification is so important, you should also understand then why market timing is so dangerous relative to always being steadily invested in the market at an appropriate risk level. We're getting near the end, and this is a picture of actually the study that I talked about earlier that I co-authored about 14 years ago. And this diagram is showing risk on the vertical axis and the number of stocks on the horizontal axis. And what it's showing is that as you go from 1 out to 10 to 20 to 30 stocks, the risk of your portfolio declines. But the reason I put this chart up here was to emphasize that those lines keep going down. And if you were able to see these slides close up, and we can get you copies that you can see really well if you can't see them now, it goes all the way to 100 stocks, and it's still going. At 100, it's still declining. What this is saying is that some people will tell you that if they've bought 10 or 20 or 30 stocks for your portfolio, they've done a great job of diversification. That is not true. You have to have literally hundreds of stocks in your portfolio, or as we do it, invest in low-cost funds that hold hundreds or thousands of stocks for you in a very cost-effective way. You have to get hundreds or even thousands of stocks to really get substantial diversification benefits. Anything else tends to be leaving a bunch of those on the table. So what's the market timing takeaway? Market timing is the process of taking greater risk exposures at some times and less at other times, and you do it in an effort to beat the market. What I believe is you want to keep an even exposure through time. It's just like diversification. You're doing a better job. Now, why is it so important to reduce your risk that way? Because remember, wealth management is a battle between risk bearing and return. And if you're taking risk because of some stock picking strategy or market timing strategy, you're never going to get the superior performance that you can get from a long-term buy and hold equity portfolio. So take the risk, the only smart way to take the risk, and that is take as much risk as you can tolerate in equities, which really brings me to an important point here. And that is how does one remain emotionally relaxed during a market crisis? How does somebody pick the proper level of risk, the proper level of equities for them? And the answer is financial planning. And sometimes we think of financial planning as this very complicated thing that you have to understand all sorts of nuances. No, the programs might be very complicated, but the picture that they're trying to create is just very realistic. It's with reasonable expectations of what's going to happen in the markets, what income you're going to be getting, when you might retire, what your financial needs might be. You put all of those into these wonderful new programs that they have, and it gives you an idea of where a rational amount of risk to take would be. And here's the key. I was very relaxed during the COVID crisis in terms of money. Why? And the answer is because I knew that I had a plan whose goals would be accomplished no matter what happened to the stock market. So look, the stock market's going to go up, the stock market's going to go down, and I can just relax because I've got a financial plan that I know that works, that's keeping the emotions out of it. Some people, what they do is they go into a bear market when the stocks start to go down, and at some point they become so emotionally frazzled that they sell. And it's almost definitional that when people that the strongest people that try hardest to fight their emotions, when they finally capitulate and they sell their stocks out, that is the definition of the bottom of the market. Because at that point, the last people that are going to get emotional about it sell their stocks. There's nobody left to sell the stocks, and the stocks start to go up. So the strongest emotional people are that are using emotion are going to be the worst when it comes to handling market crises. The way to solve this problem is to have a plan ahead of time. My wife and I, no matter how much that stock market was going down, we looked at each other and we said, we're going to be okay. We have a plan. We know that in the long run, it's the best plan. And we knew ahead of time before this crisis happened that no matter what would happen, we would not abandon our plan, because we know that if we let our emotions get into the way, we're going to regret it. So market timing is something that we might do as professional wealth managers in very small tilts that we would put on and decisions with regard to rebalancing. But it's not something that we do as an emotional reaction. We make evidence-based decisions. Stock picking takes greater risk with market timing. Concentrate risk into fewer time periods. It makes a mistake. So you have to do extraordinarily well in market timing just to make up for the added risk. It doesn't make sense. And we should also think about that when we market time, for every dollar that one person takes out of the stock market, somebody else is moving a dollar into the stock market. That's just an accounting equation. Every transaction has a buyer and a seller. So it's not like people get out of the stock markets. It's that some people get out of the stock market and others get into the stock market. You don't want to be doing that on an emotional. I urge you not to do that on an emotional basis. And the way to avoid doing that on an emotional basis is to work with us, do a financial plan, find us hopefully or another investment professional that thinks this way, that thinks about this as a wealth planning, steady as you go approach, as opposed to stock picking and market timing. That's what wealth management is about. We might place tilts or rebalancing decisions. We do it on the basis of evidence. Evidence can be theoretical or empirical. And what we really want to spend most of our time on is doing the things we know we can do right. We can't necessarily predict the election right, but we know we can diversify well. We know we can do good financial planning. We know we can manage risk well. Very importantly, we can handle taxes. That's what we need to be thinking about when this election is over. Does it change our tax plans? Does it change our financial plan? And to keep fees at a minimum. These are the three tasks that we think we should be concentrating on through the election cycle, before it and after it. And if this resonates with you, then I hope you would contact us and learn about this way of handling whatever happens in the election. And I hope that whatever it is helpful to the whole country, and that there won't be a crisis. And with that, I will turn it over to Nate.
Thank you, Dr. Chambers. I hope everyone found him as helpful and informative as I did. And thank you, ladies and gentlemen, for your time and attention this evening. Again, if you'd like to schedule a review, please click the Offers tab on the right of your screen. If you missed anything or would like to send this to other investors, friends, family, or colleagues, we will have a replay available on our website, biltmercap.com, Facebook, and LinkedIn pages. And again, if you'd like to discuss and review your particular situation, please don't hesitate to reach out to us at Biltmore Capital. Thank you very much.